Hey everyone, this is Laura Adams. I am so glad to have you joining me for this week's episode. If you're new here, I'm an award-winning personal finance author who's been hosting Money Girl since 2008. And I've also written several books. The latest is called Money Smart Solopreneur, a personal finance system for freelancers, entrepreneurs, and side hustlers. And I work with select brands as an on-camera PR spokesperson, consumer advocate, and multimedia content creator. So if you have a company or an employer looking for a personal finance expert or creator or spokesperson for media, reach out. I'd love to work with you on your project. Here on Money Girl, my mission is to help you get the knowledge and motivation to prioritize your finances, build lots of wealth, and have more security and less stress. So if you like what you hear, take a moment to subscribe, and even better, leave a 5-star rating or review. That's a great way to show us that you're getting value from the free content that I love giving you here. As always, you can leave a comment or a money question by calling 302-364-0308. Just leave a voice message, or you can send me an email using my contact page at lauradadams.com. As interest rates, inflation, and market volatility climb, you may be wondering how to best protect your savings. While certificates of deposit or CDs aren't the most exciting financial tools, they are predictable and safe, and that makes them an excellent place to park money for a period, depending on your financial goals. In our last Quick and Dirty Tips team meeting, our marketing and publicity assistant, Davina, asked, "What's the deal with CDs? What do I really need to know about them?" I appreciate the question, Davina. And since it's been a while since I podcasted about CDs, I figured this would be a great time to cover them. So if you're interested in learning more about CD types, their pros, their cons, when and where to buy them, and a technique called laddering to maximize income, stay with me. Let's start with an overview of what a CD is exactly. Well, it's a type of time deposit because you put money in an account and then withdraw it at a specified time, and that time is called the maturity date. Taking money out of a CD before maturity typically comes with a penalty, so it's generally best to buy CDs only when you're sure you will not need the money until after the maturity date. In exchange for giving up access to your money during a CD's term, you typically receive higher interest rates than with other deposit accounts, such as a bank savings account or a money market deposit account. You get a guaranteed return no matter what happens in the economy. And CD terms range from, it could be like several weeks, even up to 10 years, with the longer terms generally yielding the highest rates. And when the term is over, you get back your principal, so that's the money that you originally put in, plus the accumulated interest. While banks and credit unions generally offer CDs, they differ from savings accounts, which have no set term or maturity date for earning interest. However, many CDs are similar to bank accounts in that they typically come with FDIC insurance or NCUA, which is National Credit Union Administration insurance, if purchased from a participating institution. Both types of federal insurance, both FDIC and NCUA, protect you for up to $250,000 per depositor per insured institution for each account ownership category. I know that sounds a little confusing. Let me give you an example. Let's say you have $50,000 in a savings account, and in that same institution, you've got $200,000 in CDs. And both of those accounts, your savings and your CD, is just in your name only. So you've got a total of $250,000 at that institution in your name. So all of that would be fully covered by the federal insurance. But any amounts over $250,000 in that same institution in your name would be at risk if the bank went out of business. Now, it's not likely to happen, but it is just a good thing to consider these FDIC and NCUA limits as your balances in banks gets higher. You can spread out deposits and CDs at different insured institutions to ensure you always have ample FDIC or NCUA coverage. And if you have joint accounts, such as an account with a spouse, a partner, or a relative, that's an additional ownership category, giving you another $250,000 of coverage. So you can be strategic how you name the accounts and, where you put different funds to make sure that you're always covered. So when you begin shopping for CDs, you're going to find many different types, but you can boil them down into three main categories of CDs. And these are standard, specialty, and brokered products. So here's what you need to know about each. Standard or traditional CDs allow you to deposit money for a set period, such as from 28 days to 10 years, and earn interest. When the CD matures, you can withdraw your initial deposit and the interest earned, or you can roll all of it over into a new CD. The next category I mentioned are specialty CDs. These allow you to deposit money and earn interest, but they come with extra features, and I'm going to list a bunch of them here. So you've got no penalty, or what are called liquid CDs. They allow you to withdraw money before maturity without paying a penalty. There are raise your rate or bump up CDs. These give you a fixed rate with the option to increase your interest rate once or even twice during the term to take advantage of rising interest rates. There are step-up CDs, which give you a fixed rate for a period and then automatically increase to a predetermined interest rate. And there are step-down CDs that also give you a fixed rate for a period and automatically decrease to a predetermined rate. There are variable CDs. These pay an interest rate based on an index, such as the Treasury bill or the prime rate. There are zero coupon CDs. These pay interest only at the end of the term, so they don't allow the option for you to withdraw interest before the end of the term. There are add-on CDs, which allow you to make additional deposits to a fixed or a variable rate CD. Callable CDs, these give the bank the right to, quote, call or buy back a CD after an initial period and before the end of the term. And lastly, jumbo CDs. These require a big deposit, something like, at least $100,000, and they typically offer higher rates of interest. Now, the third category of CDs that I mentioned are brokered CDs. These are offered by a brokerage instead of a bank or a credit union. They may have higher minimum deposit requirements, such as $10,000 or more. Brokered CDs can potentially generate higher returns than bank CDs. It's based on the underlying investments that they have. But a brokered CD typically will not come with FDIC insurance because that insurance typically only applies to a bank and the NCUA only applies to credit unions. So in exchange for getting higher returns, you're going to give up that FDIC insurance. So let's quickly review the pros and cons of buying CDs. The primary advantages of owning them include getting more interest than you can with a savings account, receiving a guaranteed minimum rate of return, and having FDIC insurance or NCUA insurance in most cases with virtually zero risk. Now, the downsides of CDs are having less flexibility compared to a savings account. So as I mentioned, in general, you're going to get penalized for taking money out of a CD before the term, unless you have purchased the no penalty or the liquid CD. So you typically have to pay a penalty if you must make withdrawals of your original principal balance before maturity. And you may need a relatively large initial deposit, such as for a brokered CD, to earn higher rates. And the last downside is earning an interest rate that may be too low to keep up with inflation, and that's the case right now. The interest rates we're seeing on CDs are going up, certainly, but they are not as high as the inflation rate. Okay, now let's talk about a strategy called CD laddering. I want you to imagine that you just bought a $100,000 5-year CD paying 4%. Now, think about how bad you would feel if the interest rate for a 5-year CD went up to 5% the following year. You would miss out on earning more interest because you locked up that $100,000 at 4% for 5 whole years, and you can't withdraw it without paying a penalty. Well, with CD laddering, what you do is buy multiple CDs with different maturity dates and interest rates. You want to think about each rung on this ladder as representing a separate CD with a progressively longer term. So that helps you take advantage of rising rates over time, which is, the environment that we're in right now. And that allows you to maximize your potential earnings while keeping your savings liquid. So with a laddering strategy, you might buy 5 CDs with your $100,000 instead of just, one bigger CD. For instance, you could put $20,000 in a 1-year CD, $20,000 in a 2-year CD, $20,000 in a 3-year CD, and so on up to a 5-year CD. After 1 year, when the first CD reaches maturity, you can use all or a portion of the money to purchase another 5-year CD. So as your shortest CD matures, you use it to buy a longer-term CD that will presumably give you a higher interest rate. Laddering protects you from missing higher returns if rates rise, and you earn more money and get more flexibility. So as each CD matures, you can renew it at the current rate or use your money for something completely different. It's up to you to reevaluate what's best for those funds after, that term expires. Another important thing to think about when you are shopping for CDs is the difference between APY and APR. So you're going to see interest expressed in both of these ways as you're shopping. You want to be sure that you're making an apples-to-apples comparison. APY, or annual percentage yield, is the rate you'd receive if all the interest you earn is added to your balance and gets compounded. In other words, APY is the rate you get if you never withdraw interest from a CD. APR, or annual percentage rate, is the rate you'd earn without considering the effects of compounding in that year. So that's the rate you'd receive if you withdrew every penny of interest and you didn't allow it to compound. So when you see a CD rate that does not specifically say it's the APY, assume it's the APR. The most common reason to buy CDs is when you have a relatively large amount of cash that you want to keep safe while earning more than you could with a bank savings or a money market account. That might be the case if you're retired, approaching retirement, maybe you're just too risk-averse to invest in the financial markets, or you've got some pretty significant short-term savings goals. Buying 1 or more CDs may be worthwhile if you can lock in a great rate on money that you are confident you don't need before the term ends. And as you're shopping, you'll want to consider a CD's term, the APR, the APY, minimum deposit requirements, and any early withdrawal penalties, which are typically going to be the case except for the no penalty CDs. If you're worried that rates might rise after you buy a CD, consider one of the specialty types I mentioned, such as a raise your rate or a step-up CD. They're designed to ensure you don't miss out on a higher rate later on. However, getting more flexibility with a CD may mean that your interest rate won't be the highest possible. Since CDs are safe, they're great for your short-term goals, like maybe you want to buy a home within a couple years or even a new car. However, they are not suitable for your long-term goals like retirement or even saving for a young child's education. Why? Well, because you're just not going to get enough return to build a large balance. Remember that not taking enough risk with your money could be your riskiest move of all. Keeping all your money in savings or CDs means that you're likely going to leave a lot of money on the table, and you may not end up with enough for retirement. So I want you to remember that, putting money in CDs is not appropriate for your long-term goals. Investing in mutual funds and exchange-traded funds, especially through a tax-advantaged retirement account, is the best option for achieving your long-term goals and building wealth. If you're looking for the highest CD rates, online banks have some of the highest CD rates, but you should also check rates at local community banks and credit unions. They can offer pretty competitive CDs when they want to attract more deposits. I recommend using a CD interest calculator to determine how much you could earn with different CD products and compounding scenarios to reach your goals. Finder.com has a good one. If you just Google CD interest calculator, you'll find some great online options. As I mentioned, the longer you commit money to a CD, the more interest you earn. But if you're hesitant about locking up funds, check out rates for high-yield savings. They may pay rates that approach short-term CDs without requiring you to sacrifice liquidity. All right, to sum up, balancing risk and reward is an ongoing struggle that all savers and investors face, especially with so much market volatility. While CDs don't offer as much return on your money, they are paying more interest as rates rise, and they come with virtually zero risk. So buying CDs can be wise if you're already maxing out a tax-advantaged retirement account and still have extra money for short-term goals. But you should not use CDs as a retirement vehicle because you're simply not going to get returns that are high enough to build your nest egg, much less keep pace with inflation. If you're like Davina and have a money question or a comment, I'd love to hear from you. You can reach me at lauradadams.com. Again, that's my personal site where you can use my contact page and learn more about my work, books, and money courses. That's all for now. I'll talk to you next week. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast. It's audio engineered by Steve Riekeberg with editing by Adam Cecil. Our podcast and advertising operations specialist is Morgan Christensen. Our digital operations specialist is Holly Hutchins. Our marketing and publicity assistant is Davina Tomlin. Thanks again for that question, Davina. And our intern is Cameron Lacey.